Hi, my name's Colleen from Sutherlands Property Management. Throughout the year, we're often asked tax questions that really should be answered by an accountant. So today I'm talking with Tony Sutherland, who's a chartered accountant on the Gold Coast, and he might be able to answer some of those questions for you or prompt you to ask some of these questions to your accountant. So thanks for your time today, Tony.
Thanks, Colleen. You're welcome.
So from starting to buy a investment property, what are some of the setup costs that are able to be claimed?
Well, initially when you buy, the main costs associated with the purchase are the stamp duty and the legal fees. Now, you can't claim those immediately. They come later on, but things you can claim immediately are some of the costs associated with the borrowing and the adjustments for rates and various other costs on the settlement.
And structuring your loan, how important is that to get that right at the start?
Well, that's essential because it will affect the negative gearing, and it is best that you do that in conjunction with determining what your intentions for the property are. Is it a short-term investment or a long-term investment? And
a mortgage as opposed to a line of credit?
Well, a line of credit is one of the forms of loans you have an option to take out. And it is a flexible option, a line of credit, because it will provide you with some redraw facility later on if you need to pay for some repairs or improvements.
From time to time we do get asked when purchasing a property to purchase in their super fund. Mm-hmm. What can you give us on that one?
Well, that's a very complex area, and the owner would need to talk with their accountant in detail on that because the limited recourse borrowing arrangements are very complex and not something we could cover here today.
So with once it's settled, a tax depreciation schedule, would you recommend that?
Oh, absolutely. It's a large extra deduction which you can gain year by just getting that depreciation schedule, and I'd recommend everyone do it.
So when people buy even a second-hand property, not brand new?
Yeah, they still apply. As long as the property's been constructed after August 1984, it will be eligible for that capital allowance.
During the year, the property manager, we send the monthly statements and the end-of-year statement. How important is it for the owner then to keep their own spreadsheet?
Well, it's like everything. They must keep all of their records. It's a requirement by the tax office, but they'll need to provide that additional information to their accountant to maximise their deductions because they'll be incurring a lot of other expenses over and above what the property manager has to deal with.
And in that record keeping, the settlement date, how important is that?
It is very important because that's the date you officially own the property and then begin to rent it. So that is required by the accountant, as well as the contract date, which is also important because that involves the capital gains calculations later on.
And how long do they need to keep their records for?
Everyone needs to keep their records for 5 years after the date of lodgement of the tax return each year.
Then we've got replacement versus improvement. Can you just sort of give us a quick rundown of that?
Yeah, the best example I could give you of that would be, say, the replacement of a roof, damaged roof. If you've got a colour-blind roof and you replace it with a tiled roof, that's a capital improvement and it's not a repair. However, if you repair it like for like with colour bond, that will be deemed to be a repair and immediately deductible.
And then with replacing an air conditioning unit that's already existing?
That's a little similar in that it's a capital item, but that will have been depreciated, the old one, and you would scrap that cost, any remaining cost, and start depreciating the new air conditioning unit.
So speaking of capital purchases, what's the minimum there that they can claim?
Anything under $300 is immediately deductible. After that, if it is a capital new item in the premises, then it must be depreciated over time, but as opposed to a straight repair.
So then when they're talking about general expenses, we know that repairs and maintenance is a given. Mm-hmm. There's just a couple of other questions that come up, like electricity and water. So where that's not separately metered and can't be claimed back from the tenant, is that a claimable expense?
Yes, because it's part of the owner's cost of renting.
Yep.
So they can immediately deduct those costs.
And what are some of the other costs?
Oh, things like the property manager's fees, land tax, insurance, rates, all of those sorts of ownership costs.
Because all our properties are on the Gold Coast, they do like to have a trip to the Gold Coast every now and again. Mm-hmm. So is that claimable on their tax?
Well, as long as the main purpose of the trip is to come and either inspect the investment property, meet with the property manager, organise and effect repairs, then those costs of travel are deductible, yes.
And accommodation, car hire?
All of those costs associated with getting to inspect the property. So yes, flights, car hire, mileage on your own vehicle, accommodation, meals, things like that.
Yeah. So there's a couple of other things that we probably won't touch on today, which would be like insurance claims and the natural disaster and that sort of thing. So that might be a separate video. So getting up to selling the investment property, with selling it, are the agent's fees and legals included there?
Well, they are, because once you sell it, that triggers your capital gains event. So whether you make a capital gain or loss will depend on the sale price versus the purchase price, but also includes deducting off agent's fees, legal fees on sale, the original stamp duty and legal fees on purchase.
We often get asked towards the end of a financial year, should we sell, an owner will ask, should we sell in this financial year or next financial year? How do I answer that question?
Well, again, that's a discussion for their accountant or with their accountant, because their taxable income from their other sources will affect that capital gain. And whether they bring it forward into the current financial year or try and delay it till the next financial year will depend on those circumstances.
And with, just one final question, just with people who've become a landlord by default, so whether they couldn't sell their property or they've been transferred for their job, they've had to rent out their principal place of residence. Is there any tips for them, special tips?
Well, it gets back to that record keeping. It's just the same as an investment property. So while it's being rented, you can claim all of the expenses of owning that property, rates, insurance, their own mortgage interest, all of those sorts of things. So keep detailed records to give to your accountant.
Great. Well, thanks very much for your time today, Tony. So for more information, please go to our website at www.spmg.com.au. Thanks very much for your time. Bye for now.